Hello and welcome back to All Things Money. I'm your host David Blain. During the third segment today, we're going to talk a little bit about CalPERS, the California Pension Retirement System, the body that invests all the state public employees in the state of California, invest their investments. It's a widely watched group of people that have a lot of clout in the investment management industry. They invest a lot of money, and they've been known to be investing in all sorts of different areas. And so they released their second quarter results the other day. And I thought it would be useful to look at them and kind of talk about it. So first of all, the headline number, they returned 12.5% for the year ending June 30th. That's their fiscal year. Now, not too bad. So we look at the public equity, 19, private equity, 13.6. Oh, that private equity, you hear about that. I've invested a lot in private equity in the past. Don't really do it anymore. The returns aren't there. Fixed income, minus 1.6. Real estate, 11.2. Liquidity, minus 0.8. Inflation assets, 0.2. Absolute return strategy, 7.4. So you can see they have all sorts of esoteric type investments. And what I want to focus on is moving into all these different types of investments, is it beneficial? What does it accomplish? Have these organizations become too sophisticated for their own good? And the answer to that is yes, I think they have. And granted, the past year has been especially good for the public equity markets. I'm not disputing that, but what I'm trying to encourage you at home, viewers and listeners, is you can construct a portfolio with the help of an advisor, such as our firm, that there are things you don't have to go into private equity and all these fancy hedge funds and things like that to earn a decent return. In fact, in CalPERS' case, the return on a public equity was 19%. Now, they generally use an active type managers, trying to buy and sell a lot, timing the market, things like that. In our firm, we don't. We use what's called a passive investment strategy, meaning when we invest in U.S. stocks, we own the whole market. Now, we like to overweight small companies a little bit. Actually, we like to overweight small companies a lot, but we don't attempt to say, well, we think Coke is going to do better than Pepsi, or try to find the next Apple or Google or things like that. That is kind of a fool's game. And we can see that in CalPERS with all their money, all their clout, all their research. I mean, they got hundreds of people that work there researching the best managers and everything. They return 19%. Well, you know what? The S&P 500 index over that same period made 20.6%. The Russell 2000, which is smaller companies, made 24.21%. The EFA index returned 18, that's Europe, Asia, Far East, returned 18.62. So the only way that they were able to return lower than these basic indexes was their active managers just did an awful job. And so the point of this is that, after all these fees that they're paying to all these active managers, that as big as they are, the cost of investing should be close to zero, but they're simply underperforming the benchmarks. Now, in our firm, the way we manage money, as I mentioned, is the investments themselves are passive. How you combine them, how much in stock, how much in bond, those type of things are set by the investment strategy. And you can argue all day what the appropriate benchmark is, but the design of our portfolio will never underperform the benchmark, because the benchmark, the investments that we use are matched to that particular benchmark. Some of them are able to add value over that, but if the equity markets, the public equity markets are returning 20% or so, you should be able to capture that at a very low cost. And this just shows that even an organization like CalPERS, all the active management in the world, didn't help them, at least in that year as well. And it kind of goes to the last topic. We got a couple of minutes left here. We've talked about this before. The investment du jour, and in fact, the SEC just loosened up the rules on hedge funds. They're allowed to advertise now. There's some new rules on Twitter and posting on Facebook about hedge funds and private companies and things like that. And we're going to see more and more marketing to the regular person. And I'm just here to warn you that don't go down that path. As you just said with CalPERS, they have access to the top hedge funds in the world, supposedly, and yet they're not able to outperform even the public equity markets. There was a great article, this came in Bloomberg Business Week, July 11th. Sheila Kolhatkar, I'm sorry if I mispronounce it, but anyway, you'll have to excuse my bad language here, but the title of the article is "Hedge Funds Are for Suckers." And it talks about what we've talked about many times on the show, about how hedge funds are positioned to provide these great returns, and they're able to make money in up markets and down markets and things like that. But the reality is, once you account for the fees, once you account for what we call survivorship bias, meaning that when you look at the performance in aggregate of the hedge fund industry, the database, when these companies go out of business, they're generally dropped out of the database. And so it ends up skewing the returns of the index of hedge funds higher, because the companies that went out of business, their poor returns, assumedly poor if they went out of business, are not in that index. And we see this time and time again. For example, George Soros, who's a favorite guy of the left, he funds a lot of the left's policies. Well, many don't know that he's a hedge fund manager, and he makes his money from those evil investment people. Anyway, in 2011, he announced that he was returning most of the investors' money and converting his funds to a family office. Jamie Simons, another famous hedge fund manager, retired in 2010. So we see some of these larger managers acknowledging the fact that hedge fund returns are not what they touted to be, and it's very difficult to achieve any sort of alpha in the markets today. So we would just say beware as the advertising regulations are loosened up on hedge funds. You're going to hear a lot more about them, but for 99.9% of the people, just stay away from them. Well, that's all the time we have for today's show. I hope you've enjoyed it and that you'll come back again next week and join us for another great show.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.